Too many of you guys are making huge mistakes with your options trading. A lot of you guys are trading underlying stocks that are illiquid. By illiquid, I mean they're not very liquid underlying. So make sure you check liquidity before you trade options on a particular stock. So let's imagine you're trading the wheel strategy, my favorite option strategy. You want to start the wheel, so you decide to sell a put on ABC stock, right? Now, is ABC stock liquid? Well, the first thing you should do, check the volume. So has ABC traded at least a few million shares of stock that day? If they haven't traded millions of shares of stock that day, it's probably not a very liquid company. And then the next thing you should do is check the options volume. So open the option chain for ABC and out to the side of each strike, check the volume. Does each strike have at least a few hundred options trading? Or even better, does it have thousands of options traded at each strike? Even better, tens of thousands of options traded at each strike. And that's what some of the really liquid underlyings have. So things like Apple and Tesla, you'll open an options chain and they'll have tens of thousands of options trading at every single strike. Those particular underlyings are very liquid. The bid-ask spread is another clear indication of liquidity. The bid-ask spread should be no more than a few pennies wide, right? At least 10 cents or less. So if the bid-ask spread is greater than 10 cents, I'd be a little worried about that underlying. And the really liquid companies, again, things like Apple, Tesla, Netflix, Nvidia, Microsoft, things like that, they'll typically have, bid-ask spreads of 1 penny, 2 pennies, right? Those are extremely liquid companies. A matter of fact, if you only ever trade options on those kinds of companies, the ones that have really good liquidity, you'll be all right. You'll do okay in the options game. Now, if you only trade the illiquid underlyings, those that have dollar-wide or more bid-ask spreads, those bid-ask spreads that sometimes you could drive a Mack truck through because that bid-ask spread is so big, you're going to do terrible at options trading because every single trade you enter, you're entering at a bad price, and every single trade you're exiting at a bad price because of those horrible bid-ask spreads. Those really wide bid-ask spreads, those are not fair prices, right? To have a fair market, you need a tight bid-ask spread. Let me give you an example of this. Let's imagine that you find this weird oddball company that nobody has ever heard of. Because a lot of you guys, I see this online. You'll find Billy Bob's Logistics Company, whatever ticker symbol, some ticker symbol I've never even heard of, some company I've never even heard of. And I'll go to their options chain, and the bid ask on a particular option will be $1 for the bid price and $4 for the ask price, right? That's a $3 wide bid ask spread. That's huge. You can't trade that. That is untradeable. If you trade that, you are guaranteed to lose money. Because think about this. Let's imagine you're going to run the wheel on that stock. Well, to run the wheel, you're going to sell the put. Well, the bid price was $1. So you sell the put, you get $1 credit, right? Great. Let's imagine you sell that put for $1, and 5 minutes later you decide, you know what, I've changed my mind. I really don't want to trade this. Let me just buy the option back and close out the position. Well, to buy the option back, the ask price was $4. So you have to pay $400 to buy the option back that you only received $100 credit for. So you actually lose $300 on a quick round trip trade like that, right? That's horrible. You can't dig yourself out of holes like that. If you do that on a consistent basis, you are going to blow up your account. You're going to, or maybe not blow it up like it's going to be quick, but your account is slowly bleeding every day if you're trading illiquid underlying stocks. And I know why some of you guys are out there trading this garbage. When you're new to trading, sometimes you don't want to trade what everybody else is trading. I see everybody trading these really big tech companies, these really liquid companies like, I don't know, AMD and Netflix, things like that. I want to trade the really weird companies, the ones nobody's ever heard of, because I want to be some special snowflake. I want to find that really oddball company nobody's ever heard of, because I imagine that weird company nobody ever has heard of, that's opportunity. That's a special opportunity awaiting me. Well, no, that's not opportunity. That's actually disaster waiting for you. It's exactly the opposite of what you're actually thinking. And you can verify this yourself. If you go online, find some traders that you follow online, ones that have been trading for a number of years, not somebody that's been trading for a few weeks. Find a successful trader that has been trading, I don't know, 10 years or longer. Find somebody that's been trading that long. And if they post about their trades, see what companies these kinds of people trade. So if they're posting about it on social media like Twitter, or maybe they have a log somewhere where they log all their trades and it's available for public consumption, you can go see what they trade. What kind of underlying stocks are they trading their options on? Is it the really popular stocks and ETFs, the really liquid underlyings? 99.9% of the time it is. Because if they weren't trading those, they wouldn't have been in the game that long. So that's just the truth. You guys, especially those of you running the wheel strategy, if you're selling puts on these really weird companies, these garbage, almost penny stock, sometimes kind of companies, you guys you're failing really before you're ever really getting started. So the number one rule to trading options is only trade options on liquid underlyings. Period. Peace.